Hello, guys. Good morning, good afternoon, good evening. We will get going in about 30 seconds from now, and we'll start the show, the stream for you. Okay, so again, as I said, good morning, good afternoon, good evening, and welcome to the LiveSquawk preview stream. Um, I promise we will come up with a better title for the show in time, but this is our working title for now. Well, it's finally here, decision day for the US Fed Reserve. It's possibly one of the most anticipated events of the year so far. There's been lots of chatter, conjecture, and guessing about what Fed Chair Jerome Powell and the FOMC will decide. But whatever they do, I think we're in for a wild ride. I'll be joined by two of my learned friends to help the group through the rate announcement. Hopefully, we can help clear up some of the more confusing and contentious points for you. In terms of who we are, just to give you a quick introduction, my name's Harry Daniels. I'm a managing editor of LiveSquawk. We're a news service, audio news service that provides anyone, market participants, with live, real-time news. We do this via an audio platform, and anyone wishing to trial the service, if you want to quote stream in your application, you can go to livesquawk.com and take up a free trial. And if you find and hear what you like, please do sign up and join us. I'll repeat all the details at the end. As I mentioned at the top, today is FOMC day, really, and we're looking for the US central bank to kick off its rate cutting cycle. If you go to the website livesquawk.com, you can get this off of X as well. You'll see our latest or my preview of today's event for those who want to have a quick read of what to expect. Decision comes up. We've got about just under 2 hours away from the rate announcement itself, and then a half hour after that, we'll hear from Fed Chair Jerome Powell, who will take a press conference. The title of the piece is Fed Walks Messaging Tightrope as it begins path back to neutral. And again, Economist poll predicts marginally that rate setters will lower borrowing costs by 25 basis points this week, bringing the Fed funds target range to 5.25%. And this would mark the US central bank's first rate cut since the global pandemic began in March 2020. Just a note here from Mark Cabana of Bank of America. He described the market as unusually uncertain regarding the September meeting. Says that rates are priced in, and I think this has changed a little bit more to a 50-50 feel now, but rates priced in 34 basis points of cuts for September FOMC at the close of on Friday, and this reflected a 36% probability of a 50 basis point rate cut. Again, I think that's now moved higher in pricing in the markets over the subsequent days, but conditional on the Fed delivering a minimum of 25 basis points at today's meeting. Major bank economists remain hopeful that the Fed can guide the US economy to a soft landing. However, Cabana noted the Fed remains vigilant to downside risks to its employment mandate. On that note, let me introduce you to our first guest today. His name is Gunter, and he's an economist by training and is currently on garden leave. He speaks in his own capacity, I must make that clear, and he has over 25 years of experience in the financial industry and has held positions as a portfolio manager, salesperson, and currency strategist. I will resend his link. He's on LinkedIn and on X as well as GFXFTS. But I'll put those up at the end for anyone who wants to just view his inputs. Right now, let me just get Gunter on. I think Gunter's there. Gunter, can you hear me?
I can hear you very well. Can you hear me?
Excellent. We can. Right. I just wanted the idea of today really is to try and provide a path and an understanding for our audience as to what to expect today, and to try and cut through some of the messaging is the wrong word, but because there hasn't really been enough from Fed officials. But in terms of the markets at the moment, and we know, if you've been watching the markets for the last couple of days, you'd have seen really quite a lot of chop, quite a lot of to and fro, and an increasing wages, if you put it that, or pricing of a 50 basis point move today. And hopefully you can lay out for us what we should be looking out for and potentially what to expect.
Perfect. Thank you very much, Harry, for having me and for this occasion.
Absolute
So
pleasure.
what I've tried to do here, maybe if you could share the screen
Yeah,
to have
let me see if I
like
can do that.
a pro and con for a 25 or 50 basis point rate hike. But at the outset, I would like to reiterate the message I get from the Fed, which is that it's inherently dovish. We had already two other sessions, and I remain of the view that they are dovish and they will continue to be so. And why is that? So first of all, regarding the inflation mandate, after the introduction of this flexible average inflation targeting framework, I think that kind of introduced a dovish bias. Why? Because they are more reluctant to tolerate inflation which is below their 2% target. On the other side, if inflation overshoots, they are more likely to tolerate it. So this basically this catch up model of
Right.
inflation. The second one is recently they've highlighted risks to the labor market. They see signs that it might be deteriorating. We have this famous ZARM rule, and they're quite concerned and think inflation is close to target and under control, and now they can focus more on the labor market growth. And last but not least, they also have financial stability in mind, and I think the bailout culture at the Fed is still around. We had the recent example when we had this mini crisis among the regional banks in the US, SPV, and they got the bailout. And that, if you remember, that introduced a new rally in the stock market. So let's come back to today's decision. I think 50 to 60% chance is priced in that they do 50, so it's very important, but still some uncertainty. What's the reason why they should only do 25? By the way, I'm in the 50 basis point camp. Proponents of just a 25 basis point rate cut would say that monetary policy is not that tight. If you look at financial conditions, stock markets, credit spreads, and so on, they are quite high, credit spreads tight, and maybe also the neutral rate is higher than in the past. And a 50 basis point move could either propel stock markets or asset markets higher, or it could also smell of panic, and therefore you want to do a gradual cut. On the other side, many Fed policymakers think monetary policy is tight. I have a chart here where I deflated the the nominal Fed fund rate by certain price measures. You can take CPI, PCE, break-even inflation rates. And in the recent periods, let's say from 1995 onwards, you could say we are at the upper end of this real rate. So, we had a period where it was much higher, but let's say we are still in this regime. We are at the upper end, so we are a bit tight on a real basis.
Right.
Especially if you also take into account future inflation rates, which might be falling still. Then, with regard to inflation, it's coming down, but there remain risks. If you look at oil prices, they could spike. Trump tariffs would be inflationary. So that would be the argument for the 25 basis point rate cut. But my view is if you look at commodity prices, they've been falling quite sharply, especially oil. I think that's the cornerstone of the commodity block for me. Rents are lagging. That's at least what the Fed thinks, and therefore I think it as well. And if you believe Harris might win, I think that outcome would be less inflationary than a Trump win. And then, the unemployment rate is rising uncomfortably so, and Fed's Powell's speech at Jackson Hole highlighted that. So they're worried, and then if they are worried about the labor market, we should be as well and focus on that. So I think they don't want to take any chances with the economy, given that inflation is heading down, and therefore why not cut 50? Some say they should have cut already in July, so maybe there's a bit of catch up as well. And then we still have these famous long and variable lags, so maybe monetary policy is still tight, and we haven't seen the outcome yet in the real economy, although current data suggests we are not in a recession yet, but it can change with 1 month of data. And then I think one of the strongest arguments is they kind of geared or steered the market into the possibility of a 50 basis point rate cut. And if they now do only 25, then I think it would be a major disappointment. And why take this risk that the stock market then dives 3, 4, or even more percent, 10%? It's really unnecessary from their perspective. And then one thing I've noticed is that these reverse repos the reserves are dwindling down. So we are now at 256 billion. So excess reserves in the system are becoming less. I don't think they want to run it down to zero. So maybe also the next discussion is with regard to quantitative tightening. What's the optimal level of reserves in the system? Waller has written about it. So I could see them also making some noises at some stage, maybe not today, but in the future, that maybe quantitative tightening needs another tweak, and therefore,
Just to just
yeah.
to just to explain that for some of our listeners, in so on the quantitative tightening side and the balance sheet, it's you're talking about trying to drain a bit more liquidity out of the money market system.
Yeah, currently they're doing that exactly.
Yeah.
But the question is, how far do you go? Do you also maybe want to be there a bit more prudent on that front as well?
Okay, and just to explain to our audience again, for those who are probably less clear, um, they injected a lot of money into the system following March 2020, when we had the global epidemic, just to help credit, to help borrowing, to help keep the economy afloat. Some blamed that level of injection of cash into the system. As having this inflationary effect that we've had to, well, the central banks have had to fight since. So in terms of what you're saying is they have to now tweak that again to try and reduce that level of liquidity at a pace that doesn't handicap the economy, doesn't send the economy into a downward spiral, and no money in the system basically. But they want to take out that extra cash, that loose money that's jangling around, and take it out of the system. So just want
Absolutely, yeah.
to
Because
right.
they've been burned last time when Powell was famously saying we are now on autopilot and reduce the balance sheet, and then it all went horribly wrong with the money market rates spiking and so on. So they want to prevent that.
Yes, absolutely. So I just wanted to make sure that our audience had an idea about that. Excellent, thank you.
So famous last words. So should I be right, and they do cut by 50 basis points, that would be still a bit of a positive surprise for the markets, I think. And I think it would also confirm the reflationary period we are in, i.e., I would expect cyclical effects to perform well, gold, stocks, bonds, everything basically. And should they sound dovish? The risk is, of course, a short-term risk is they only do 25. Of course, knee-jerk would be lower in asset markets, but then we shouldn't forget that they will continue to cut rates, right? Also, of course, we have the press conference. It will be important to see what they do. Also with the projections, the dots, if they move them lower. So lots of question marks. But I think at the end of the day, they're dovish. And so I would rather fade those sell-offs and go into the position than jump on it and think the world will now implode. But long term, I could see another scenario, but that's really 6 to 12 months out.
Sure.
That should they cut, we see an acceleration in growth. Tentative signs, we already seen a manufacturing survey picking up. It's a second tier one in New York, but still, if that theme continues and they increase again, then the Fed will at some stage also stop cutting rates, and then it's positive for the dollar.
Looking at into the forecast briefly, and then I'll bring in our second guest, Joseph Choi, of Curve Advisor, just to give you some of the background on what's expected from the SEP, the projection update, really, and we'll discuss the dot plot, but we are looking for the dot plots to be to show more. I think if I can get the wording right, to show more cuts going into this side of Christmas. The surprise from the June FOMC SEP update for the dot plot itself was that they took two rate cuts out and saw only one cut this side of the new year, which was the surprise in the marketplace, and the hawkish rhetoric that I think, or undertones that I think the market took from that meeting. Many expect this to now be replaced and to put back into calculations. I want to try and see if I can get. I'm still new to this. Bring up if I can find it. There was there is a chart that suggests that shows the it's Bank of America Merrill Lynch, and that shows you the updated the expectations for September's SEP. And for 2024, there isn't a great deal of change from June to September in terms of GDP, 4 quarter on 4 quarter, looking for that growth rate to say 2.1. But they are looking, and I think this isn't uncommon amongst analysts, for a downgrading of growth, if only by 0.2 for 2025 and 2026, from the 2% rate seen in June. In terms of the unemployment rate you were talking about, we're looking for that to tick up, edge up over the course of the next year, before falling a touch in 2026. And then for the inflation, again, not a lot of change this year from either the PCE inflation picture on an annual read, or core PCE annually, 2.6 and 2.8 respectively. But then for 2025, again, we're looking for a slight dip from PCE, and for a tenth for both PCE, core PCE and PCE inflation. And then for 2026, again, they've left it unchanged in terms of expectations from June to September. So yes, in that sense, I think there's not going to be a lot that we can get from the updated projections. It will be this dot plot and how much they're planning. What the Fed members, and by the dot plot, it's where every member gets to place a dot and give their projection to the rate cut or rate cycle as they see it, or where they see Fed funds at a point over the next, I think it is 3 year term. So on that note, I'd like to bring in my next guest, Joseph Choi. He is a futures and options trader, long-standing futures and options trader with many, many years under his belt, and also the author of Curve Advisor. And whereas we heard from Gunther just now, and he's sitting in the 50 basis point cut camp, I think, Joe, you're of the 25 basis point cut camp. That's where you're sitting. Is that right?
Well, I understand the arguments for a 25 better than a 50, but it is a very close call. Well, first of all, let me say it's a pleasure to be with you again on LiveSquawk. So if you look at the Bloomberg ECO function, you can see that over 90% of economists think that the Fed will go 25 today, and this is contrasted with the 55% of a 50 that's priced into the markets now. So there is this dichotomy. So anyone that has like any kind of economics background is going to lean more towards the 25, because really the only thing that has gone poorly. Well, there are two things. So one is the employment report and the unemployment rate, and the second is the last beige book was terrible. So because more districts reported weakening than strengthening,
Sure.
but I think this sort of highlights the issue that we've been having in general with survey data. Because of lower participation, and there are just a lot of there could be a lot of issues with the survey data. So the reason why I bring up survey data is that if you remember last year when Powell made his dovish pivot, it was also on the back of a very weak beige book. And so in that beige book, it actually read at least as bad as this current beige book, if not worse.
Mm-hmm.
And as we all know, inflation popped higher, and so did growth after that. So, so there's just been this issue with the survey data and how that translates into real data. Like, another example would be the ISMs. Like they've been, negative below. The ISM manufacturing has been below 50 for the better part of 2 years, and so it hasn't really been a great predictor. So because of these two diverging sentiment, it's like because the Fed, I think, is more concerned at this point about the risk management aspect as opposed to the how the data has actually been coming out. And
Sure.
so if the Fed decides they need to go 50 for risk management reasons, I think there's a strong perception in the markets that a 50 is going to be a hawkish 50, and a 25 is going to be a dovish 25. And so we'll be able to see from both qualitatively and quantitatively. So quantitatively would be in the dots. So we can see what kind of pace of hikes the Fed expects after this current meeting, as well as for next year. And then, qualitatively would just be what Powell says in his press conference. And, I think the markets, after initially having interpreted 50 as being very concerning for the economy, the way it's traded is so after the initial Wall Street Journal article came out towards the end of last week, we had actually priced in almost 5 eases into this year.
Right.
And I think since then the markets have had a rethink, and that's why the past 2 days we've seen, while the September meeting has increased in pricing, we've started to see a lot of the contracts in early 2025 like lead a sell-off, and a noticeable sell-off at that. So I think the markets. So I think the markets are going to mostly try and focus on the medium term picture as opposed to this immediate cut.
That's interesting you say that, because I do think maybe the market itself, and maybe we're talking speculators and intraday traders, are looking at this as an event in itself, as opposed to what it means for monetary policy as a whole, what it means for the US economy as a whole. And we can get very polarized as traders and investors in the here and now, rather than looking at the bigger picture maybe, and taking a step back and understanding this is the first step of potentially many steps to correct monetary policy to and get it more into balance with where the economy currently sits. Would that be correct?
Yeah. So I think so in terms of the dots, I'm actually just expecting it to come in around 3.5. So I actually don't round the dots like the media does.
Sure.
So I think it's going to be greater than 3. Like, I'd be surprised if a majority of the people wanted more than 4 eases for this year. Uh, and so in that way, if I'm thinking 3.5 dots for this year, nothing's really changed that much in terms of the economic outlook or anything like that. It's just the Fed, if they go 50, the Fed just wanted to take out a little extra insurance. And if they, do less, they're less concerned about it, but they will sound, or they should sound, more dovish.
Right.
The other thing I just wanted to mention is this whole situation was actually not started by anything related to the data. It was the Wall Street Journal article that came out on Thursday that implied that we could get a 50 and they're on the fence. And I think it's a very valid argument because it is a close call. The only two major people we heard from after payrolls was Waller and
Williams.
William, and they
Yeah.
both lean towards the 25. And so I think what must have happened is that Powell or some other senior people on the FOMC were probably also on the fence, but they were leaning more towards the 50. And I would have expected some sort of clarification article from the Wall Street Journal earlier this week, but we didn't get any. So I think they really are torn between these two choices. And I think
Sorry,
that,
they being the
oh,
Fed.
the FOMC.
Yeah.
Yeah, the FOMC, I think are actually, I mean, I think this is going to be a very close decision. So uh, I just don't know that there are that many traders that are focused on this decision. I think most people are probably looking a little further ahead and more towards, year end or, early next year and trying to judge where they think the Fed funds rate will be there. Because I think at this point, the market realizes it's going to be a close call and but it doesn't necessarily change the outlook unless Powell says something shocking like that implies we're going to get more 50s or anything like that. But the Wall Street Journal article that came out today sort of poo-pooed that idea. So um,
It is quite interesting. I'm sorry, I do think it's quite interesting that we're not talking about what Fed officials say. We're talking about what journalists are saying and what those, the likes of Greg Ip, Nick Timiraos, and oh God, who's the third who used to be Hills and Raff,
yeah, Tails and Rap.
and comments that they've made as opposed to. Do you think the Fed has failed? And this is a question to both of you. Do you think the Fed has failed in its communication with the markets in terms of trying to not surprise? I mean, central bankers, I don't think want to surprise the markets. They want a smooth transition whenever they, especially when they begin a new monetary policy cycle. Do you think they failed in that respect? Gunter, I'll ask you first, and then we'll come back to Joe.
No, I think Joe's right. Maybe they're really divided in discussing it, and therefore wanted to convey the message that they're as uncertain as the market is, and that there's still a little bit of a surprise element in today's decision.
Okay, so you're happy to think this reflects the dilemma that they have within the community at the moment.
Yeah.
Okay, interesting.
Well, so I guess my take is that if the Fed only ends up going 25, which is very possible, I think it brings up the question of how useful is having this Fed whisperer to begin with, because the article caused rates to, at least some of the short-term interest rate futures rates to rally like 20 basis points and now sell part of it back off. So if what you're trying to prevent is from the front meeting, moving 20 basis points in one go, I don't know that that's necessarily better than having us go 10 basis points or 15 basis points, then whip back 15 or 20 basis points. Because if the whole point was to reduce market volatility, it's not clear that this is the way you go about reducing market volatility. The other issue we have is that Nick Timiraos is a fine journalist, but he does write his own articles. And so, sometimes they're going to, depending on the slate of guests that he has, they're going to lean more bearish or dovish. And so just having
Joe, I think you cut out. Hopefully that's not me. Gunter, can you still hear me?
No, I can hear you. I can't hear Joe, unfortunately.
Yeah, I think Joe, you cut out for a bit. Just before we can we'll try and get Joe back and find out where he is. But just to give you a note, this is from I sent this from a friend of mine.
1 year,
Oh, sorry,
one
Joe.
year out.
Joe, you cut.
He's back.
Joe, you cut out for a bit there. We lost you about 30
okay.
seconds ago.
Oh, yeah. So I guess I was saying there has been a whipsawing of rates further out the curve.
Right.
So, So I don't know that. So it just seems like we got a lot of volatility and no answers. And then now we know for certain that, the front rate is going to move at least 12 basis points today. So, we had volatility all this week. And then on top of it, we're going to have at least a 12 basis point move today. So, so I think the communications may be better to have the members do it as opposed to having a journalist. But we'll see how things turn out.
Yeah, I mean, these journalists could be absolutely reflecting what we've seen or what the Fed is thinking and how it intends to act. I just want to give you a quick. This is from former Goldman Sachs chief European economist and now CEO and founder of Extante. And a friend of mine gave me this quote from him, and he's done a study into meeting and over meeting. Revelations and in terms of how much of a surprise we get when we start new cycles. And he's put it in a historical and record-setting meeting. Says the consensus for today's FOMC is that the dots for 2024 get revised from 25 basis points cut in the June projection to a total of 100 basis points now, a 75 basis point revision. That would be a record dovish revision in the history of dots if that were to be the case. So again, you can see the gap. This is between two quarterly sort of SEPs projections that we've seen such a varied range of expectations at this point now. So, for my personal opinion, I think for a central bank that doesn't necessarily want to surprise the markets, and I get what Joe says about maybe you get that momentum going, and it's a less painful journey if you have to retrench rather than go the other way and reinforce rate cuts and expectations. But I think it just goes to show you that maybe it's such a hard job, and I wouldn't envy Powell and his guests and his colleagues, just trying to communicate what is a moving target and trying to, especially on the turn when you've got an economy that's potentially on the turn, and we potentially could see it dip into recession, although it's not showing signs of that. It could dip into recession by the end of this year, maybe next year, and contending with where inflation is right now, where you're seeing the labour market right now. There's a lot of moving parts, I think, for this, which is one of the reasons I believe we're seeing such contention within the markets and such whipsawing within the marketplace. So just to go on to that then, so if we take this year aside, that we are again, there was a City piece that we're looking for 150 basis points of cuts over the next 3 meetings. If we decide that if they go 25 today, market reaction to that, I think, Joe, you've touched upon it as in what you were saying, but market reaction, you think they'll go after more, that initial reaction, or do you think it's all really about, irrelevant of 25 or 50, it's really about what Powell sits down and tells us at the press conference?
Yeah, so my key focus after the 25 or 50 is actually going to be where the 2024 dot is, because that will tell us a lot about what they're thinking about in terms of their reaction function. So, if they go 50, I think there's a good chance that the next 2 meetings will probably only show 125 bip ease afterwards. So 4 eases total this year. And if they go 25, it's hard to say if it's going to be 3 or 4 eases for this year, but I do think that if they go 25, Powell is going to keep the language very flexible, saying if he sees any hint of further weakening, that they could go more aggressively. So in that way, I think the very front contract could be a lot more volatile than a contract a year from now, because I think the path to get to a year from now is a lot narrower than the short-term path in the next 1 or 2 meetings.
Okay, interesting. Gunther, would you go along with that?
Yeah, so I think a 25 basis point rate cut is a tough sell, especially if they then lower the dots and try to sound dovish, because then the first question which will come up in the press conference is, why didn't you then cut 50 in the first place? So yeah, I remain of the view 50 sound dovish, stay course. If you're confident that inflation is falling towards target, at least in the short term to medium term, and if you're concerned about the labor market, take no chances, take out insurance and just do it. And if the stock market rallies, fine. Greenspan never was worried about a rising stock market. He said, is it a bubble or not? I don't know. We are here to clean up the mess. Should it be a bubble, and it does, if it bursts afterwards, then they clean up the mess. So he looks at financial conditions from a central banker's point of view, and therefore looks at real interest rates. They think they're too high. They have to come down. Therefore, you cut rates. They don't care about credit spreads are tight or stock markets are at historical highs. I think that's our view, and therefore we say, oh no, they shouldn't cut too much. They have a different angle, I learned at least. Maybe I'm wrong, but
Do you not think that's evolved from the days of Greenspan, though? Do you think that there are times when the Fed probably meddles when it should try and stay out of the this goes for any central bank, that they interfere too much,
absolutely.
hence why we got what we got with this
Yeah.
this non-transitory inflation a couple of years back.
Yeah, exactly. And they're a hostage of the markets now. Since Greenspan, since LTCM, since all these bailouts, people now expect them to be there when they're needed. And yeah, I agree.
Yes, I think that's us oldies think there's general social culture rather than just a central bank one. Okay, listen, guys, I think hopefully we've cleared up some of the conjecture out there and just given a case for 25 or 50. We haven't really examined the potential that they go 25 and then decide that they don't want to give it a particularly dovish message to the markets, which would be, I think, absolute carnage. But I think that there's very little risk in that, if we're honest. And I think it would be particularly irresponsible of a central bank to guide down a path, or to let the market go down a path only to completely cut off that particular avenue and go somewhere else. So although it's unlikely, I just want to mention that there's also a potential out there, but I don't think there's a lot of scope in terms of thinking about that being the case. So I just want to give, there's a JP Morgan piece here as well, and I just wanted to give some of the bank views as well. They say, with more balanced risks to the Fed's employment and inflation mandates, we think basic principles suggest the Fed funds rate should be in the vicinity of neutral, to be better positioned to respond to whichever risk is realized. Most estimates of neutral are at least 150 basis points lower than the current policy setting. So at a rate cutting tempo of 25 basis points a meeting, it takes almost a year to get policy back to onside. And they say, we think this motivates front-loading easing at the start of the cycle, particularly since with hindsight, it might have been appropriate to start the cycle in late July, which is something that we discussed a little while ago. So just to quickly recap then before we finish for the day and let people get about their business heading into the decision. The decision comes up in just over an hour and about 6 minutes from now. The press conference will be 30 minutes later. And we'll put the we'll put up the previews already up there from LiveSquawk.com. Don't forget to go to LiveSquawk.com and sign up for a free trial if you like what you hear and you want to know a bit more about what we do. Just to quickly go over what the expectation is. So we're looking, the consensus is for a 25 basis point cut today, that should bring the rate, the Fed funds rate range from 5.25%, 5.5% down to 5.25%. We're looking for updated dot plots and economic forecasts from the SEP, and within those forecasts, we're looking for little change really for growth and inflation, but maybe a slight downtick to growth, and inflation really sticking to projections noted back in June. Thank you, Gunther. Thank you, Joe, for your time. I'll put your monikers up on our X page so you can see, people can see how to get in touch with you. Thank you very much for joining me, and I'm always grateful for your two big brains and your opinions on the matters that we talk about, because I do think, again, we have some great guests on, and you guys epitomize just that clear thinking that we want our audience to sort of to gain knowledge from. So thank you very much to both of you from that. And yeah, well, we'll see you again in the future for future programs, and good luck with this evening.
Thanks a lot, Harry, and thanks for a great Squawk service. It's really value added.
Oh, thank you very much. Much appreciated. Thank you. And Joe, thank you very much again. Curve Advisor, go have a look at Curve Advisor. And Gunther, we'll, again, as I said, we'll put up your address and everything. And yeah, guys, please, as I said, go to our LiveSquawk.com if you want to understand a little bit more about what we do. If you want to take a trial of the service, if you do, I think there's a code you can put in stream, and we'll give you a discount if you sign up. But yeah, thank you very much. Thanks for listening, and we'll see you again very soon.
Thank you.
Thanks. Bye bye.
Bye bye.